depression.
So for the average person, what kind of strategy should they be adopting if you're not someone that has a huge amount of savings? Say you're working for one of these big companies. Are there any strategies that you should be thinking about now before the markets come down and there could be a recession?
I mean, rule number one is always be diversified.
What does that be diversified mean?
It means hold some bonds, hold some cash, perhaps a small amount of precious metals.
Like gold and silver?
Yeah.
And what is a bond? And how do I buy one?
Yeah, a bond is a loan that carries a fixed interest rate. Let's say today, 5%. You invest your money in it, and it will pay you 5% as long as the credit worthiness of the other side is there. So if it's the U.S. government, you'll assume it's pretty credit worthy, and you buy a bond from the U.S. government. It's how the U.S. government funds a part of its activities. You can buy a 30-year U.S. government bond, a 10-year bond, a 2-year bond, a 90-day treasury bill, they call them, when they get that short. Everything goes fine. You receive this modest amount of money. You're 5% or you're 3%, depending on the conditions.
Okay, so a bond is basically lending the government money?
Yes.
And if you want to lend the government money...
lending a corporation money.
Okay, so you can also lend, like, Apple money?
Yes.
And I can go to the government website, or it says, I was just reading here, it says, if you want to lend money directly to the US government, you can bypass Wall Street entirely, go to treasurydirect.gov, you open an account, link your bank, and purchase directly. You can buy treasury, bills, notes, bonds, and Series 1 savings bonds. You pay exactly face value with no commissions or fees, and the investment is backed by the full faith of the US government. Or you can buy, like Apple, you can lend Apple money. I didn't even know you could do this. And you go to any of your major brokers like Fidelity or Vanguard, or probably a lot of the apps. You navigate to fixed income section on your account, and you can see what bonds are being offered, and you can lend them money.
What you're doing, actually, they have distributed it to the market, and you're acquiring it from one of the existing owners.
Oh, okay.
You're not actually giving them incremental money. They come to the market with $10 billion in a particular bond with a particular coupon. It says, we will pay you 3.5%. That's the coupon. And when you want to buy some of that bond, you go to your broker and he says, it's no longer selling at the original 100. It's now selling at 92 or 107, and you pay that and it transfers from one owner to you. There have been times in 1974 when you could get a bond that would pay 8, 9, 10%.
Per year?
Yes, per year.
So if I buy a US government 10-year treasury bond, essentially lending the US government money, I can do 4.46% a year, and Apple's current yield on a 10-year corporate bond is 4.7% a year, so almost 5% a year, which means if I put, $1,000 in, I'll make $475 over 10 years. Interesting. I never really knew how bonds work. So you're saying markets collapsing, diversify, get some money into bonds, keep some money in cash, and anything else in terms of diversified portfolio? Property?
Property is fine, except it's pretty darn expensive by historical standards. They've engineered a situation where house prices tend to rise. Great for the people who have a house, and terrible for the people who would like to buy a house. Back in 94 in England, a typical house sold for 3.4 times your family income. That was about as low as it had been for 50 years. And then from 94 until today, it rose from 3.4 times to over 10 times, depending on where you live. And at 10 times income, a reasonable young couple are in big trouble. They can't really afford to buy a house. And that same high prices are reflected in rents. So they're really squeezed on living costs. And the same is true, even worse, in China, in Canada, Australia, most of Europe. House prices have simply been allowed to go up for the last 30. They didn't, traditionally, they traded flat or down 60, 70, 80 years until 1994 in the UK. But since then, house prices have risen everywhere.
So are you expecting house prices to come down sharply? I think I heard you say that they might come down 30%.
Even if they come down 30%, they're really still very expensive, aren't they? That would be, they'd come down to 6 or 7 times family income. They'd still be twice what they used to be in the good old days.
So I've got diversify, I've got reduce your position. There is probably going to be a bit of a job disruption as well.
And particularly if you have to